Welcome to the deep dive. We are jumping straight into our sources on Uranium Energy Corp. That's ticker UEC. And we're doing this because, well, something pretty unusual seems to be happening with this stock. We've got a good stack of materials here, detailed stock analysis, policy summaries, financial notes, all trying to make sense of one big question. How is a company that's, mostly been developing projects suddenly trading like it's a major established producer? UEC's stock has just, well, ripped higher. It's up over 26% in just the last month, currently trading around, $13.67? So the mission today is to figure out what's really driving this velocity and if the fundamentals we see in these documents actually back it up.
Absolutely. And before we dive into those details, which are really quite fascinating, we need to be crystal clear about one thing. This conversation is based only on the sources we have in front of us. It's purely for informational purposes. The uranium sector is known for being volatile, extremely so sometimes. So nothing that we discuss here is financial advice. Nothing. You absolutely must do your own homework, your own due diligence before making any investment decisions. Okay,
mission established, rules clear. Let's get straight into this core conflict then, because this is where things get interesting. The market momentum versus the, let's say, more conservative valuation metrics.
Yeah, it's a perfect snapshot of what you see in speculative energy investing sometimes. You look at the sources, and there's this really sharp disagreement on what UEC is actually worth intrinsically. So stock's trading up near $13.67, right?
Right.
But the consensus analyst fair value estimate, it's quite a bit lower. It's at $10.74. And then some of our own internal price targets, which tend to be more conservative, well, they're way down around $7.67.
Wow, okay. That's a pretty wide gap.
It is. And what it tells you right off the bat is that the market is paying a pretty hefty premium for potential, for the future, not for what the company's doing right now. Investors are clearly anticipating something big down the line, maybe a huge operational success or, maybe policy changes really hitting home.
That definitely helps explain the volatility then. I mean, the 52-week range in these notes is $3.85 on the low end and $15.06 on the high. That's a massive swing. So if it's the strategic potential being priced in, we need to ground ourselves in the current financial reality first. What does that look like? Let's hit the bear case just based on the numbers.
Okay, yeah. If you look strictly at the numbers UEC is posting right now, they paint a picture of a company that's investing very, very heavily in future growth, not current profit. So when we look at the trailing 12 months, the TTM, basically the last year of reported operations, the profitability metrics are, well, deeply negative.
No negative are we talking?
We're talking net income for the TTM period at negative $75.72 million. Yeah, and earnings per share, or EPS, also negative. It's negative 0.18 for the TTM. And the forward estimate actually worsened slightly to negative 0.22. And the margins, forget about it. Net profit margin is negative 113.29%. Operating cash flow over the last 12 months, negative $53.62 million.
Okay, so standard valuation ratios like price to earnings.
They don't really apply meaningfully here. PE and forward PE are strongly negative, like negative 76 and negative 61, respectively, because there just aren't any current earnings to measure against the price.
Wait a second. Okay, losing over $75 million a year, negative cash flow. Normally, for a company not yet generating steady revenue, those kinds of TTM numbers could be, well, disastrous for the stock price. Why hasn't this thing collapsed? What's keeping it anchored if the current earnings picture is so bleak?
Okay, that's the critical context point. It's probably the most important piece from these sources regarding their structure. It's the balance sheet. The underlying financial structure lets them absorb these kinds of development stage losses. UEC's balance sheet is exceptionally strong in one key area, debts. They report zero total debt.
Zero debt. In mining, that's pretty remarkable. It's such a capital-intensive industry.
It really is. And crucially, they also report having $321 million in total liquidity. Now, that's a combination of cash, their uranium inventories, and other marketable securities as of July 31st, 2025, according to these notes.
So that liquidity cushion is key. It's absolutely key. It allows them to pursue this long-term growth strategy without being constantly worried about near-term financing crunches or, being forced into unfavorable deals. It completely reframes how you have to look at those negative earnings.
Right. That liquidity, that zero debt.
Yeah.
That's the foundation for the whole bull case, isn't it? And that brings us nicely to the strategic narrative. The story that seems to be fueling that big 26% price spike we mentioned. They're making a big shift, right, from just development to actual production.
They are indeed. The documents really detail some pretty aggressive operational momentum, especially in their U.S. in situ recovery operations, ISR they call it. And this is important. UEC reported some initial low-cost production, around 130,000 pounds of U3O8.
Okay.
And they did it at a total cost report to be only $36 per pound.
$36 a pound. How does that stack up?
Well, according to these sources, $36 per pound is genuinely among the lowest production costs reported for any U.S. ISR operator. That's a potentially serious competitive advantage on the cost side.
And they're scaling this up. Oh, yeah. They're ramping up efforts, expanding Christensen Ranch in Wyoming, and they expect the Burke Hollow project down in South Texas to be starting up by December 2025. So the production numbers should start climbing.
But, okay, low-cost mining is one thing. But the real wow factor in these notes, for me anyway, seems to be this vertical integration strategy. It feels like they're trying to become more than just a miner.
That's exactly it. They're aiming to be a strategic national asset, almost. You could argue they're trying to, privatize a critical piece of the domestic nuclear fuel supply chain.
And that's tied to this new initiative.
Precisely. The launch of the U.S. Uranium Refining and Conversion Corp, UR&C, they're calling it. That initiative seems to be what investors are really paying that premium for. UEC is trying to establish the first fully vertically integrated domestic supply chain. So covering everything from digging the uranium out of the ground to refining it, and then doing the conversion step needed to make actual reactor fuel.
And that conversion piece is critical, right? Because the U.S. doesn't do much of that domestically now.
Correct. The U.S. currently relies very heavily on foreign sources, including, until recently, Russia, for that vital conversion step.
Yeah.
UEC is positioning itself to basically own that potential bottleneck, but domestically. And this whole plan gets a boost from some smart strategic moves, like buying the Sweetwater complex.
Yeah.
It was a $175 million acquisition.
Sweetwater. Wasn't there something special about its permitting?
Yes. Crucially, it carries what's called a Fast 41 designation. That basically puts it on an expedited track for federal permitting.
Which is huge in mining. Permitting can take forever, years and years.
Exactly. Delays in permitting can absolutely kill projects like this in the U.S. So having that Fast 41 status is a major, major advantage for speeding up the timeline on that key asset.
Okay, so they're building capacity, they have low costs, they're integrating vertically, and they're speeding up permits. And all of this is happening just as Washington seems to be pushing all the buttons for nuclear power and domestic supply.
The policy tailwinds described here are frankly unprecedented. The documents mention this repeatedly. There's this intense push from the U.S. government for energy security.
And the Russia situation plays into that directly.
Absolutely. The Russian uranium ban, which is set to take full effect by the end of 2027, maybe even sooner in practice, it's creating mandatory, essentially inelastic demand for non-Russian uranium fuel components. You add to that other initiatives mentioned, like the Strategic Uranium Reserve, plus broader policy goals, including things like former President Trump's executive orders aiming to quadruple U.S. nuclear capacity by 2050.
Right.
Well, UEC, being arguably the leading, well-capitalized, purely domestic player with permitted assets, they're just perfectly positioned to potentially command a real premium for U.S. origin nuclear fuel in that environment.
Okay, so let's try and pull this all together. We've got this really strong strategic story. I mean, debt-free, potentially low-cost producer, vertical integration plans, massive policy support. It's compelling, but we're buying into that story at a price that's, significantly higher than what the current financials might suggest. It screams high risk, high reward. What's the biggest financial risk that jumps out from the sources here, balancing against that potential?
Well, the primary risk, and it's quite visible in the data, comes down to the capital structure, specifically equity dilution. The sources clearly show that to fund all this rapid expansion, the $175 million for Sweetwater, ramping up development elsewhere, they have been issuing shares.
Ah, okay. So how significant is that dilution?
It's noticeable. The number of diluted shares outstanding has climbed quite a bit. It's gone from around 375 million to roughly 430 million shares.
That's not insignificant. That dilution actively works against the share price gains, right? Each existing share owns a slightly smaller piece of the pie.
Exactly. So the question becomes, how quickly does UEC need to turn these strategic assets into reliable, growing profits before that ongoing dilution starts to seriously erode the potential upside for shareholders.
That's the balancing act.
That really is the critical challenge. This dilution is effectively the price they're paying for this aggressive M&A and development strategy right now. They're clearly prioritizing gaining market share, getting that vertical integration going today, and they seem willing to accept the short-term impact on the per-share value to achieve that longer-term strategic position. The key is that the money raised is going into tangible, strategic, permitted assets like Sweetwater and funding that UR&C initiative, assets they believe are essential for future profitability.
Okay. And there's another trade-off mentioned here regarding how they sell their product, right? Something about being unhedged.
Yes, that's the other side of the risk coin. Their strategy is 100% unhedged. Because they have zero debt and strong liquidity, they have the financial flexibility to not lock in future sales prices via hedging contracts. They can afford to hold their uranium inventory, wait for market prices to rise, and sell at potentially higher spot or near-spot prices. Like the sources note, they sold 810,000 pounds at prices above $82.50 per pound in the first half of fiscal 25.
So they get maximum upside exposure if uranium prices keep going up.
Maximum upside. They capture the full benefit if these policy tailwinds and global demand really take off, unlike producers who have locked in lower prices through hedges.
But the flip side.
The flip side is maximum downside exposure, too. If the uranium price drops unexpectedly, their entire strategy suffers. Their inventory value falls, future revenue projections drop instantly. There's no cushion from hedge production.
So they're making a huge, deliberate bet on the future price of uranium itself.
Precisely. And that volatility risk, that dependence on the commodity price and the success of their big strategic bets, is why you see such a massive spread in analyst price targets. We saw $7.75 on the low end in some targets, up to $17.50 on the high end.
Yeah, huge range.
It just shows the market isn't valuing UEC based on predictable, stable cash flow right now.
Yeah.
It's placing a highly speculative bet on whether UEC can successfully execute this transformation into basically America's cornerstone nuclear fuel supplier. So, at the end of the day, the ultimate determinant of UEC's future value creation, it's going to be whether that UR&C initiative, the vertical integration in their operational ramp-up,
Right.
whether all that can translate these strategic advantages and policy tailwinds into actual sustained, measurable profitability. That's what needs to happen to eventually justify and hopefully grow beyond the current elevated valuation.
That is the perfect way to frame it. That's the intellectual knot we leave you, the listener, with today. You walk away knowing UEC is this fascinating company, debt-free, strategically positioned as a leading domestic player, riding potentially huge policy tailwinds. But you also know you're buying that future potential today at a price that's well above conservative estimates based on current financials. And you're taking on substantial risks related to share dilution and the inherent volatility of the uranium market. Okay, that wraps up our deep dive for today. Thank you for engaging with us on this complex topic. If you appreciate this kind of analysis, cutting through the noise, getting into the details from the source material, please do support the channel. Make sure you hit that subscribe button and definitely click the bell icon too. That way, you'll stay instantly informed every time we tackle another complex topic like this one. Thanks for listening.